Imagine walking through an ordinary neighborhood market. There are two shops. One has a glowing sign, a futuristic name, a crowd outside, and a product everyone is talking about. The other has a name nobody remembers. It sells something so ordinary that you barely notice it. Bottle caps, packaging, maintenance parts, some small service that businesses need every day. If someone asked you which shop you would rather own, the answer would probably be obvious. The exciting one. But investing has a strange habit of turning obvious answers upside down. Because the question is not really, which shop is more exciting? The better question is, which shop can keep making money while everyone else is busy chasing excitement? That is where the story behind a stock begins. One of the simplest ideas in investing is also one of the easiest to ignore. Understand the business before you fall in love with the stock. A complicated business can be profitable. A brilliant management team can build something extraordinary. A futuristic industry can genuinely change the world. But if you cannot explain in simple words what the company actually does, you are already depending on somebody else's story. The simpler business gives you an advantage because you can observe it. You know what a tire is. You know what a restaurant does. You know what a bottle cap does. You know what happens when a customer keeps coming back. And when the business is so boring that nobody wants to talk about it at a party, something interesting can happen. You may get time. The source material makes this point through businesses with deliberately unglamorous names and even more unglamorous operations. The argument is not that a boring name magically creates value. It is that boredom can keep attention away long enough for the underlying economics to become visible before the crowd arrives. Think about that. The market often pays attention in the wrong order. First comes excitement. Then comes popularity. Then comes expectations. And only later, sometimes much later, comes the question. Can the business actually deliver what everyone is expecting? That distinction is crucial. Because a wonderful business and a wonderful stock are not always the same thing. Imagine you find a restaurant that is genuinely excellent. The food is fantastic. Customers love it. Sales are growing. The restaurant has almost no competition. You might think, what a great business. And you could be completely right. But now imagine someone offers to sell you that restaurant for the price of 10 years of its future profits. The restaurant hasn't changed. Your investment has. That is the strange part of the stock market. You are not simply buying a business. You are buying a business at a price that already contains somebody's expectations about its future. And this is why a boring company can sometimes be more interesting than a fashionable one. A boring company may have room for surprise. A fashionable company may have no room for disappointment. That difference becomes enormous when expectations become extreme. Look at the examples in the source. Carpets became a booming industry. Demand exploded, technology improved, prices fell, sales increased, and profits initially surged. It looked like exactly the kind of growth story investors dream about. Then hundreds of competitors entered. Everyone wanted a piece of the same opportunity. Prices fell. The industry grew, but the profits disappeared. The same pattern appeared in other fashionable industries. Disk drives could grow rapidly while dozens of companies fought for the same customers. An industry can therefore grow spectacularly while its shareholders earn very little. That sounds contradictory until you change the question. Don't ask only, how fast is the industry growing? Ask, who is allowed to keep the profits? That is the difference between growth and profitable growth. A highway can become busier every year, but if 20 companies build parallel highways and compete by cutting tolls, traffic growth does not guarantee great economics. Now imagine a different business. Something heavy, something local, something nobody wants to transport very far. A rock pit. The product itself is almost worthless. But the location matters. If your nearest competitor is too far away, transportation costs make it uneconomical for them to attack your market. Suddenly, something ordinary becomes a protected business. The source describes this kind of local niche as an exclusive franchise, The product may be simple, but geography can make competition difficult. That is a powerful way to look at businesses. Sometimes the moat, the thing protecting a company's profits, is not a famous brand or revolutionary technology. Sometimes it is simply that competing with a company is inconvenient, expensive, regulated, geographically difficult, or unattractive. And sometimes the best protection is even stranger. Nobody wants the business. Think about waste, grease, sewage, funeral services, dirty industrial processes. These are not businesses people usually dream about owning. But that lack of glamour can become an advantage. The Source's example of Service Corporation International is particularly revealing. It operated in an industry most investors would rather avoid, yet it built scale by acquiring local funeral businesses and developed recurring economics around prearranged funeral services. For years, professional investors largely ignored it even as earnings were increasing. There is a subtle lesson here. Competition does not always come from another company. Sometimes the biggest competitive advantage is simply that intelligent people with plenty of capital don't find your industry attractive enough to enter. That is why a no-growth industry can occasionally be more attractive than a high-growth industry. High growth attracts people. People attract capital. Capital attracts competitors. Competitors attack margins. And eventually the very thing that made the industry exciting can destroy the economics that made it attractive. A boring industry may grow slowly, but if one company keeps taking market share, raising prices sensibly, cutting costs, and serving customers repeatedly, the company can still grow much faster than the industry. That is the difference between industry growth and company growth. A company doesn't always need the whole market to expand. Sometimes it simply needs to become better at taking a larger piece of the existing market. And that brings us to another question investors often forget. What happens after the customer buys? If people need to buy the product again and again, the economics become much more predictable. A toy may become the must-have product of the year, but a child generally doesn't need another identical toy every month. Compare that with medicines, everyday consumer products, replacement parts, basic services, or anything people repeatedly consume. The Source makes this distinction between products people buy once and businesses serving recurring demand. But even here, we have to be careful. A repeat purchase is not automatically a great business. The real question is, why does the customer keep coming back to this particular company? That is where brands, distribution, patents, local advantages, switching costs, and habit begin to matter. And sometimes technology creates another interesting opportunity. You don't always have to own the company making the technology. You can own the company benefiting from it. If computers become cheaper, the computer manufacturer may face brutal competition. But a company using cheaper computers to perform its existing service more efficiently may simply become more profitable. That is a completely different way of thinking about technology. Instead of asking, who invented the new machine? Ask, who is making more money because the machine became cheaper or better? Now suppose you found such a business. Simple, boring, protected, recurring customers, improving economics, maybe even some form of insider ownership. You begin getting excited. And this is exactly where the investor faces the next danger. The story starts becoming your story. You stop looking for evidence. You start looking for confirmation. Every positive quarterly result feels important. Every negative development suddenly has an explanation. Every warning becomes temporary. You are no longer investigating the company. You are defending it. So reverse the process. Become the prosecutor. Don't ask only, why could this stock work? Ask, what would destroy this story? What happens if competition increases? What happens if margins return to normal? What happens if the expected growth slows? What happens if management makes a poor acquisition? What happens if the attractive niche disappears? What happens if the market has already priced in everything that could go right? That final question is especially important, because even an exceptional company can become a disappointing investment when expectations become absurd. The source gives striking examples of companies whose businesses remain strong while their stocks performed terribly because investors had already priced in unrealistic growth. McDonald's, EDS, Avon, and Polaroid illustrate different versions of the same problem. The business can be good while the stock is overpriced. This is why the phrase cheap compared with what matters. A stock falling from 1000 rupee to 700 rupees is not automatically cheap. A stock trading at a low multiple is not automatically cheap. And a stock trading at a high multiple is not automatically expensive. The real question is, what future is today's price already assuming? Imagine a house. Someone tells you, this house is 30% cheaper than it was last year. You might feel excited. But then you discover the roof needs replacing, the neighborhood is deteriorating, and the house has lost its best tenant. The discount suddenly looks less impressive. Now imagine another house whose price has barely fallen, but the neighborhood is improving, occupancy is rising, and the owner has just renovated the property. The first house may be cheaper. The second may be the better investment. That is the difference between price and value. And there is another trap waiting for investors: the hottest stock in the hottest industry. These stocks are seductive because everyone around you appears to agree. The price rises. The news is positive. Analysts are optimistic. Friends are talking about it. The stock becomes part of everyday conversation. Then you buy. But popularity itself can become a warning sign when expectations run far ahead of reality. The source describes examples such as Home Shopping Network, where spectacular rise was followed by an equally spectacular collapse, and Tom Brown Incorporated, whose once popular all-service stock fell from $50 to $1 as the underlying balance sheet and economics failed to justify the excitement. And perhaps the most dangerous phrase in investing is, the next Apple, the next Amazon, the next McDonald's, the next great compounder, the next multibagger. The comparison sounds flattering, but it quietly replaces analysis with association. You stop asking what the company actually earns and start imagining what it could become. The source warns that stocks promoted as the next famous company often carry enormous expectations, and many such imitators subsequently performed terribly. There is a reason this happens. Stories are easier to sell than arithmetic. But arithmetic eventually gets its turn. And perhaps that is the deepest lesson hidden inside all these strange examples: bottle caps, funeral homes, rock pits, waste management, cigarettes, computer services, and companies with names nobody wants to mention at a dinner party. The great investment opportunity does not always announce itself. Sometimes it looks ridiculous. Sometimes it looks boring. Sometimes it operates in an industry everyone has stopped caring about. Sometimes the company is growing not because the industry is booming, but because it is quietly taking customers from weaker competitors. Sometimes its advantage is a patent. Sometimes geography. Sometimes a brand. Sometimes distribution. Sometimes simply the fact that nobody else wants to do the work. And sometimes the opportunity appears when the market is temporarily looking somewhere else. But none of these characteristics guarantees success. They are clues. And a clue is not a conclusion. That distinction may be the most important one of all. Because when you discover a company you like, the temptation is to ask, how much can this stock go up? A better question is, what kind of business would have to exist for this investment to work? Then look underneath the ticker. Look at the customers. Look at the competition. Look at the balance sheet. Look at management. Look at how the company uses its cash. Look at whether insiders are willing to put their own money behind the business. The source treats insider buying as a meaningful signal because management is putting personal capital at risk alongside shareholders. And look at what the company does with its shares. If a profitable business is buying back its own stock sensibly, the number of pieces into which the company is divided can shrink, allowing continuing shareholders to own a larger portion of the economics. The source contrasts this with dilution, where issuing more shares can spread the recovery across a larger shareholder base. Then ask the uncomfortable question. What could make me wrong? Because the goal isn't to build the perfect story. The goal is to find a story that survives investigation. And perhaps the strangest thing about investing is that the perfect stock doesn't look perfect when you first find it. It may look boring, unfashionable, too small, too ordinary, too unpleasant, too complicated for a cocktail party, but simple enough for you to understand. The market will always offer you something exciting, a new technology, a new industry, a new next big thing, a stock that has doubled, a stock that has fallen 70%, a headline telling you why everybody should buy. But underneath all of that noise is a business. And businesses don't care whether they are fashionable. They care about customers, costs, competition, cash, capital, and whether they can keep doing something valuable better than somebody else. So the next time a stock catches your attention, don't immediately ask whether it can become the next multibagger. Pause. Look at the business. Ask why it works. Ask how long it can work. Ask who can attack it. Ask what the price already assumes. And then ask the question that can save you from both excitement and fear. What could prove my story wrong? Because the price is visible. The story is underneath. And every stock has a business behind it. Every business has a story. The real edge begins when you stop listening only to the story the market is telling you and start discovering the story the business is actually living. That is the story behind stocks.